Good afternoon to all of you. Myself, I am Dr. Sanjib Pattnaik. I welcome all of you to our session, which we will be undergoing for the next 1 hour regarding trading and settlement in the securities market. But beforehand, our particular subject is coded as MMPF 007, that is equity markets. Now, when we try to talk about equity markets or markets in general regarding the securities, we are talking of how investors are investing their money in the economy. So here we try to look at the Indian market, investment market, as the equity market as well as the debt market also. So particularly when we are talking of equity markets, the equity shares either they are bought or they are sold for the first time, that means initial public offering, or the existing shares, that means which have already been issued to the general public by the companies, by the organizations, they are traded, and particularly in the stock exchanges where they are listed. Now, when we are talking of this equity markets, the first thing that we discussed about is the new issues. What are new issues? Now, suppose a company is newly formed and it wants investment in the company in the form of equity share. Now, what are these equity shares? Now, the total capital requirement of the company is divided into equity shares, each having a face value, which is usually 10 rupees. Now, from the number of equity shares, the company may go for the public offer, that means for the first time, whereby they have been authorized only. That means out of the total capital base of the company, whatever is authorized to be issued as a equity share as initial public offering, that much shares the company will issue to the general public. Issue means they will offer to the general public. So we say initial public offering, IPOs. Similarly, existing companies, out of their uh, authorized capital, they can also go for remaining authorized capital to be offered to the general public. That is further offers, we can say. So here we are talking about for the first time when either a new company or a existing company issues the equity share to the general public. That means anybody in the Indian economy or citizen of India, they can apply directly. Now, out of that, if the issue is successful, then the company tries to make the things. That means it has to give the shares to the equity shareholder, keep a record of them so that they can be tracked, and equity shareholder also get their shares. Now, when we are having equity share in our hand, for that we have paid money to the capital. That means our money is invested in the form of capital in the organization where we have purchase the equity shares. Uh, think of that after having the equity share, a need arises on my side or the investor side that uh, I require some kind of funds. Where can I get it? Now, immediately, my attention will go to where my investments are. That means the equity shares. Can I sell these equity shares? That is the question to be asked. So when I can sell the equity shares easily, then we call it as they are having liquidity. So is there any place where they can be sold up easily or traded easily? The answer is yes. So the place is the stock exchanges. In India, nowadays we are having the electronic platforms or the electronic stock exchanges whereby anybody sitting anywhere can transact in the electronic form, make payments, make trades, etc. by sitting at his convenience. So if our investment in the equity share does not provide us liquidity, then people will not be interested in putting their money in the equity capital of a company. So that is why secondary markets come into the picture. What is that secondary market? Now, where the shares already that have been issued to the shareholders can be traded. That means not from the IPO stage, but afterwards they can be traded at a particular place or at a particular electronic platform. Usually we say the stock exchanges are the place for trading, or the secondary market is represented by stock markets, whereby the investor can trade their equity share. That means buy or sell the equity shares. Now, in that secondary market, how the trading is done, and once a trading is done, the payment process as well as the uh, change of hands of equity share has to be taken up. That, in other words, is called as settlement. So in this particular unit of our block 3, which is covering secondary markets, the first thing we shall try to learn is the trading and settlement, how securities are traded and how every transactions are settled. Now let us see what we understand as by the term secondary markets. Just now we are discussing about the already existing securities in the hand of the investors. If the need arises, the investor wants to convert them into the liquid form, or in other words, the cash. So where they can trade. Now we say in secondary market. So secondary market are the place for trading in existing securities like stocks, bonds, options, futures, etc. Stocks, we know that those are the equity shares of a company. That means that money is represented as owner's capital. Bonds, etc., are the debt funds or the loan funds or the debts of a company. Options and futures are derivatives which are based upon the stocks and bonds. Now, the secondary markets consists of recognized stock exchanges. In India, we know that earlier the stock exchanges were prevalent. That means a place was prevalent called as stock exchange. The major thing was, we can say, it was Bombay Stock Exchange having the maximum listing, and along with that we had around 21 regional stock exchanges. So these are the places which provided the facility for trading of the existing securities. Now, how they are operating? Now, they are operating by having their bylaws, the rules and regulations duly approved by Government of India. Now, who are the regulators? Regulator means those who try to see that the operations of the stock exchanges are fair, transparent, and it is not a, we can say, biased one, or you can say influenced one. So, for overcoming this kind of difficulty, we have Securities and Exchange Board of India, that is SEBI, and Reserve Bank of India, that is RBI. Now, what is the basic intention of a secondary market? We say it provides liquidity to investors. In other words, the investors can trade their securities in the secondary markets, and if required they can get back their funds or cash. What is the purpose there? The discovery of fair price of securities. Now, in secondary market, what happens? Suppose, think yourself as you are having certain securities of company A. Similarly, other people will also be having shares of company A. Today, you suppose require that I want to sell up my 100 securities that I am holding of company X in the market. Similarly, other shareholders of company X may also be thinking the same. I will sell off my securities in the market to have cash. Now, a number of shareholders would be wanting to sell those securities in the market. That means secondary market. So they order their brokers who on their behalf will act in the stock exchange. What do they do there? Now, whatever is the price quoted by us as an investor, suppose today company X security is rupees 100, and the past trend is saying it is continuously starting to fall. So, before further fall in the share prices, I want to sell it off. So, market price, suppose I say that I will sell it at rupees 80 per share. Market price is now 100. Similarly, other investors should be there who would like to purchase those securities by paying you the cash, the money. So, there will be what we can say, tug of war between what should be the actual price of the security. That means the buying rate and the selling rate, they will come to a particular matching point. So that matching point becomes the fair price of securities according to demand and supply in the market. So the purpose of secondary market is to discover the fair price of securities. Now, secondary markets have been classified as for corporate and FIs, that means the financial institutes, the Bombay Stock Exchange, NSE stands for National Stock Exchange, OTCEI, Over the Counter Exchange of India Limited. What happens here? Now, in stock market, one can participate through their brokers if their companies or the company is listed in the stock exchange. That means recognized by the stock exchange to actively trade there. So, if you want to sell up your shares or purchase the shares of a particular company, you see whether it is listed in the particular stock exchange, and accordingly you try to ask your broker or the electronic broker firm to do the respective task. However, sometimes small companies usually do this. They know that their demand for shares or the shares of those company demanded by the general investor is very very less. So in order to sell them, what one can do? Now they can approach their brokers either to sell it off in the secondary market, that is stock exchange or stock exchange platforms, or they can privately negotiate with another investor party who will purchase your securities by paying you certain amount as decided by you only. So here it is not a fair price, it becomes a convenience. So we say outside stock exchange, whatever are the trades undertaken, they are over the counter exchange of India Limited. And for government securities, which has been divided into two types, the money market securities and long term market securities. When we are talking of long term market securities, we are talking of securities which have a maturity. Maturity means their life period of at least 1 year and above. So, what are the money market instruments? Now, those instruments which have a uh, lifespan of less than 1 year, like treasury bills, short term treasury bills, etc. Now, let us look at the Indian history regarding the trading and settlement, how it has done in the or done over the recent years. Earlier, we may say that around 1854, 53, 1853, it is around 180 years back in Bombay. Bombay was famous for the supply of cotton to the European nations. That means from the Bombay harbor, ships loaded with the cotton were taken to the European nations. Now, suppose I am a trader. I make a full load of ship. I bring full load of ship cotton and send it to a particular party in the European nation or to another nation. In the way, there are certain uncertainties, risks involved, risks in the form of weather conditions, risks in the form of the what we can say, the thieves, pirates, etc. They may come around and loot the ship. Now, if such kind of risk really happens, then the whole loss will be taken up by me. That means I will be the sole sufferer since it is only my cotton that was loaded in the ship and was being taken to the other country. Instead of doing that, one Parsi and three traders, the Gujarati traders you may say, they usually sit together during 1854 1853 in front of the Bombay City Hall or the town hall in those times they were calling. They used to sit under a tree, and if they wanted to trade, they will decide that for a ship load, this is my proportion of investment. Another person will say that this is my proportion of investment. So, what happens if the ship load of cotton reaches the destination and sells off the item? The whole amount or the profit amount comes back and is distributed to the shareholder according to the proportion. Shareholder means these four persons. Now, if any certain risk arises, maybe due to weather, due to pirates, etc., then our loss making or the loss which we would have undergone if we had sent a full load of cotton ship to another country will be reduced drastically to our proportion of investment. So the thing of partnership grew. So from that came up the idea of shareholders. How much is your participation in the total capital invested in a particular company? In those days, Bombay was famous for export of cotton. Ahmedabad was known for cotton textiles. Calcutta was exporting jute or jute products. So the four persons, when they transacted, as I said, during 1853, 54, or before that, other traders also saw their activities. They also tried to join them up. So day by day, the number of participants it increased. So it was moved from one place to another where it was convenient to hold all the participants who were increasing day by day. Finally, the Bombay Stock Exchange, in those days it was not known as Bombay Stock Exchange, but it is one of the oldest in Asia. The group that was formed, they moved to a place called as Dalal Street. The traders were called as Dalal, and the street was named as Dalal Street. So in 1874, all the members or all the Dalals, they went to Dalal strict. In 1875, they formed an association, which is the basic beginning for later on Bombay Stock Exchange, the Native Share and Stock Brokers Association. That formed the share trading activities in India. So later on, it was named as Bombay Stock Exchange. In 31st August 1957, the Bombay Stock Exchange was recognized by Indian government under the Securities Contract Regulation Act. So now it came to be named as Bombay Stock Exchange. However, the requirement of trading was so high or was increasing so at a rapid pace that it needed further more space to do the transactions. So during 1980, the Bombay Stock Exchange was moved to Firoj Jijiboy Towers in the Dalal Street of Bombay. That is the place where we have the Bombay Stock Exchange now. Now, let us look at the trading system that was happening earlier. Prior to 1994, there were 21 regional stock exchanges. That means places where traders were there to actively participate in supplying capital to the various organizations in exchange of securities. 21 regional stock exchange were present, and the securities were in physical form. When we say physical form, it is a paper based certificate. That it will be mentioned your name, your serial number, distinct number. Then similarly, it will be written the face value, etc. So a certificate on a paper form or in physical form will be given to you. In the regional stock exchanges, what was happening? There was open outcry system on the trading floor. Now, on the trading floor, suppose I am an investor, I ask my broker that you purchase 100 shares of Tata automobiles at rupees 1000 per share. Now, what the broker will do? He will be sitting near the trading hall. It will ask a jobber. Jobber means Jobber. It means that a person who will try to tell everybody with a loud voice that what is the trade the investor is wanting. I want to purchase 100 shares of Tata automobiles. So the jobber on this floor of the trading hall, he will be shouting 100 shares. I want to purchase at a value of rupees 2000 each. Similarly, lots of people will also be there who either will be selling or will be purchasing the Tata securities. Suppose there are 5 persons trying to sell up the Tata automobile securities. Here, the 5%, suppose one will be saying 100 Tata's automobile securities are being sold for rupees 2500. Another is saying for rupees 2300. Another is saying rupees 2800. Like this, they will be quoting their prices. However, as an investor, I want those securities, 100 shares of Tata Automobiles, but at a price of 2000 rupees. Suppose a certain investor wants to sell up the Tata automobile shares by giving an order to that person's broker that I want to sell up 100 Tata automobile share at rupees 2000 each. Immediately, there we find there is a match between the requirement and the person agreeing to give them. That means between the demand and the supply. So, whenever there is matching, we say that trading is done or trading has taken up. Now, here we can add jobber or the person who works on the behalf of uh, the broker. Similarly, other jobbers will be there for all the brokers. So, in the field or in the floor of the trading hall, the jobbers will be shouting at their loudest of the pitches or voice that this is their transaction, this is his transaction, he wants to sell up, she wants to purchase, she wants to sell up this company's equity share, etc. So, if this happens, the place becomes unbearable to do anything or any work. Because open outcry system, they will be shouting at their full volume. That can happen through great, we can say neck or speech volumes. The scenario was just like fish market. If you have visited a fish market, the fish traders will be shouting at their loudest that please purchase from me. I will take 200 rupees per kg. Other fish traders will also be there. They will also be shouting their particular amount they are ready to pay. Now, this thing, when we are shouting at loudest of our voice, suppose 1000 persons are shouting at their loudest of voice inside the trading room. What is the scenario? Now, nobody can know who is saying what. So, earlier there was open outcry system on the trading floor. Open outcry, the jobber will be going to the shopping floor and will be shouting at the loudest of his voice. There also was no transparency. Why no transparency? We can say that is, since we have fixed a price and we are taking it to the marketplace, we do not have any idea what is the current selling price of the particular shares. This is the era I am talking of prior to 1994. So, how much I have sent? Similarly, thousands of investors will be doing the same thing. Either they will be ordering to buy or ordering to sell their securities. But how much transaction is done? At what price? These answers are not available to all at the same time. So we say transparency is very less or there is no transparency. Then comes the part of the clearing house. Pay in of securities to the clearing and settlement house was an Herculean task, particularly for FII, foreign institutional investors. Now, in the stock exchange trading floor, if a certain transaction has met its match, suppose I said na, I require to buy suppose 100 shares of X company at rupees 10,000 each. So 200 into 10,000 becomes 20 lakh rupees. This thing somebody else might not be knowing at what price the transaction was done, how much were traded. Other people, instead of those who are sitting near or around you or listening to you, nobody else will be able to know about it until the transaction is recorded and you find the results in the next session. So, paying of securities to the clearing and settlement house. You have to give your securities to the clearing house because clearing house will deliver those securities to the buyer. So, this was a Herculean task, gigantic task. Why? Now, because of large volume of shares. In those period, around 4,000 companies were listed in Bombay Stock Exchange. Now you see, how can I gather information from this huge volume of shareholders? So it becomes a Herculean task. According to the number of trades of a particular company, we try to find out what is the overall trading in on any given day, as well as any transaction taken up by the investor requires a transfer deed. Suppose I make a matching of buying 100 shares at rupees 200 each from another party. That means the other party is also ready to give me the 100 shares at rupees 200 each. So, how much I am getting? Is there a transfer deed whereby I will take the cash and the other party will take the securities into his or her own name? Now, these things have to be recorded because they are large in volume. In the earlier days or prior to 1994, we had securities in material form. What is material form? No, securities in the paper form or certificate form. Later on, it was changed to electronic form. But when paper form of securities were there, suppose I have in paper form, since I am selling up my equity share, I will give the equity shares to the clearing house after the transaction is made. The clearing house will deliver those securities to the other party of the trade. Now, every day, the securities were carried from the clearing house to wherever it is to be distributed. And also cash to be paid to the various investors who have liquidated their securities. And this was done in the nowadays you might be looking at ATM machines, bank ATM machines, they require cash. And in order to transfer the cash, there are special vehicles which are covered from all sides with security guard holding a big gun will be sitting in the van, etc. etc. So in those days, in whenever transfer of shares were done from the clearing house to the either stock exchange or the investor who have purchased the shares, a security guard or security was provided to the transportation vehicle, which was just like our cash carrying vehicles for the bank ATMs. Now, after reforms, what are the things that were done to the trading system? We know that the desktop computers were prevalent or started being used more and more. And after reforms, when the economy started growing at a very fast pace, you required assisted calculations, assisted record keeping, etc., which could be done through computers only. So the stock exchanges also changed their way of trading from open outcry to online, screen based electronic trading system. There was transparency because all the information on real time basis will be flashed or will be showing in your computer monitor. So transparency of whatever is the price of the last trade of the particular company's shares could easily be viewed. For that, information efficiency is required. Information efficiency means what are the number of trades being done at what price. All these things have to be passed on by the stock exchange to the information requirement part. The trading system also needed operational efficiency so that we could have low transaction cost. So the nation, whole of India, instead of having regional stock exchanges, etc., it became a single trading platform. The trading terminals were created also in other countries, that means abroad. And nowadays, you will be finding on the mobile phones, you can trade on the electronic trading system directly, that is internet trading. During this reforms era, three stock exchanges were established. One is NSE, National Stock Exchange. Second is Over the Counter Exchange of India Limited, OTCEI. And finally, also we had ISE, Interconnected Stock Exchange of India Limited. The screen-based trading system SBTS was fully automated and up to date with the modern technologies. So we say SBTS was automated and modern. When you are talking of over the counter, what we mean by it? It is the direct trading between two parties with no involvement of stock exchange or brokers. For whom it is more beneficial? From the small, unknown, unlisted companies. They are small in magnitude, small in their financial resources. They cannot go for listing procedure in stock exchanges. So, small unlisted companies wanted also to trade in their equity shares, but not in stock exchanges, but through private arrangements. So, just like two parties sitting together and deciding something, they did the same thing in the over the counter trading. But it was full of risk, high risk. Suppose a certain person takes your equity shares, purchases your equity share. He or she has to pay you. Suppose he or she doesn't pay, what happens? The risk will be borne by you. So after reforms, these are the trading system ushered in. Now two important things came up regarding trading. After stock market crash in 1992, the National Stock Exchange was established in 1994 with all modern facilities, all modern computing techniques. This facilitated an electronic trading system, that is NEAT. So NSE started NEAT, National Exchange for Automated Trading, from November 3rd, 1994. Similarly, Bombay Stock Exchange also changed its open outcry system on the floor to the electronic format. So BSC, that means Bombay Stock Exchange, switched to fully automated computerized mode trading. And the BSC online trading system, that is BOLT, BOLT, it is Bombay Stock Exchange online trading system on March 14, 1995. Member brokers can enter orders for buy or sell of securities listed in the respective exchanges. That means general investor, they have to ask the member brokers that you do this particular task for me, either to purchase it or to sell it. And the whole thing was order driven. Order driven means we put up all the kind of orders into the electronic platform, electronic trading system. Now, from these orders, the electronic system automatically tries to search for the best possible match. And if it is agreed by both the parties that we will go for the trade with the best identified trading by the electronic platform, then we say that it is order driven thing. So this electronic trading system, which was order driven, replaced the open outcry system, as earlier it was happening in Bombay or 21 regional stock exchanges. Now, order placement. How can an investor order the things? The user logs into the trader workstation TWS of the exchange. You have to log in, you have to create an account there, and then you can carry forward. You place the order whereby some of the parameters I have taken up. There may be other parameters which you will be adding to the thing. One is script name and code. Suppose financial accounting is learned by the students. For that particular paper, we have a subject code. Similarly, every company's securities which are listed in a particular stock exchange, they are assigned a code along with the script name. So the company's script name, whatever it is, the equity share, like Tata Automobiles, and its code as it has been guided by Government of India, that has to be put up. Second thing, how much shares or how many shares are to be traded. That means the quantity. Similarly, what is the price? That means what should be the price of the securities, that also we try to know. Once you log in and fill up all the data regarding the quantity of shares to be traded, the price at which the trading has to take place, etc., a order number is generated automatically. Now, this order number is verified by order validation system. If accepted, order sent to order matching system. And these are all in real-time basis. Just like nowadays you are using these online platforms to order certain things, either maybe vegetables or maybe food items, etc. Anything you can go by electronic format. Whatever are the orders sent, after we can say acceptance by the validation system or the counterparties, both the parties, the order is sent to the order matching system. You have seen, if yes, then the order that has been logged in is passed on to the trading house. But if rejected, an alert message is sent to the user. So depending upon the trading activity, trader can be investor, that means those who invest only, purpose of putting their capital is for long term basis, investing only. Speculator, that means they try to beat the market with their experience, which are not scientifically judged. If they are correct, they get profit out of the market. If it is not, then they get or suffer from losses. Hedgers, people are there who want to reduce their risk. So they take counter trading in the stock market. When they sell, they also purchase the things, so that the counter thing will balance one profit from one transaction may balance the losses from the other transaction. So they are always in the mood of doing away with the risk component or the losses component. Finally, arbitrators. Arbitrators are the traders who take advantage in the sense that they make profit by trading in a particular commodity or share or whatever it is at different prices that are existing at two different places. They buy from wherever it is less, they sell at wherever it is high. They are called as the arbitrageurs, the persons who take advantages from the price differential in the same asset class. For trading on exchange, one has to become a registered trading member. There are three type of members according to the hierarchy level. We have trading members, those who act on behalf of the customers. Then we have trading and clearing members. They not only do the trading part but also try to have the settlement done. That means they clear the thing, clear the transaction through settlement house. And there are similarly only professional clearing member. Their activity is only to provide the services to the trading members or others for clearing the transactions. Order execution. Now, when an order is matched, it is sent to the matching system. That means order enters into the system and becomes a active order. It tries to find a match. Then only the trade can happen. If matched, trade is generated. Otherwise, if it is not matched, it remains as it is as an passive order. All order in the system can be modified till the trade or end of the trade hours. That means during market hours. For any kind of modification, the user have to inform the order and trade management system if the trading has not yet been done and receives a message. And orders which are not traded can be cancelled during the market hours. What are the types of order execution that happens in the marketplace? Market order. When this type of order is placed, it has to be executed immediately at the current market price of the trading. No price is mentioned for the trading, only quantity is mentioned. Limit order. Best price for trade is specified. Suppose you are selling up the shares, then it will be ordered as rupees 200 or more. So if the price of the security in the market reaches 200, it can be sold up. Stop loss order. Do not go for losses whether it is buying or selling. Similarly, you have market if touched. If the share price reaches a particular level, then we have the transaction called as MIT. Day order. Whatever is the best possible trade price that we are having for buying or selling during a particular day's working hour, that is to be taken up. Another is good till cancelled. The order will be there in the order management system till it is cancelled. Another is immediate or cancel. That means you have to do it instantaneously if the price is available. Otherwise, cancel it. Now, the clearing and settlement, when we are clearing the thing, we mean that we determine the obligation. One has to give the securities, and the other party or the counterparty has to take the payments. And this has to be done through the clearing house, and the settlement is completed by T plus 1 day. It means the trading day plus 1. And the settlement is done through multilateral netting. That means whatever are the trades done by a particular member, it is netted or taken together at the end of the day, and whatever are the end result, they are given to the member. In India, we have clearing corporation who take charge of clearing the trades. That means facilitate the trading by taking the shares and paying to the other party. For that, we have National Securities Depository Limited, where nowadays our securities are kept in electronic format. So, with this, the trading and settlement part of the secondary market, that means the trading, we have a glance how the trades or the settlements are done. With this, let us end our session. Thank you.